Good morning. I'm Michael Henley, the CEO and founder of Brandywine Oak Private Wealth. I'm joined by our Chief Investment Officer, Peter Kim, to discuss the latest market trends, kind of what's going on in the market year to date, and talk about this recent volatility we've been having. So 2025 has been a rather volatile start. We like to say that volatility is the emotional price that we all pay to create wealth over time. So Peter, let's talk about the volatility and what's going on this year.
Yeah, it's been an exciting year so far, right? The first start of the year, it was very much deregulation is going to be a new thing. Everything's going to be coming back to America. Everyone's very optimistic. Then in February, it's all about tariffs and how doom and gloom everything's going to be and how the economy is just going to totally collapse. And you're seeing the whipsaws kind of on both sides, but volatility is kind of a normal thing for the markets, right? Statistically, you should have 5% correction roughly about 3 times a year. Markets should go down about 10% every year, and it should go down at least 15% basically every year and a half. So we're seeing normal volatility. It's probably a little bit earlier than anyone expected, but we're seeing normal volatility, and I think that's probably a good thing for the markets.
Got it. And it seems like I think some investors are kind of surprised by this because we haven't had a 10% correction off the highs since 2023?
Yeah, it's a good call. Since October was kind of the end of that, of 2023. So yeah, it's been a while since we've seen kind of these big corrections like this, and I wouldn't even call this a big correction, we're just a general correction.
Yep.
But when you haven't seen it a while, it seems new, and it seems exciting, and it seems like the world is kind of falling on you.
And with the tariffs, I mean, that's almost a self-inflicted pain, right? So it's a so if the market continues to sell off, would you expect some, maybe release some pressure on the tariffs, or how would that work?
We'll see.
Okay.
I think it's very much up in the air in terms of how long these go on, how serious they're going to be in terms of trying to generate some sort of change. The byproduct of this, and no one's really talking about, is that the dollar is getting weaker. So that's kind of absorbing a lot of the impact of the tariffs right now. So it kind of depends on how long we see this go on. But yeah, until we get some clarity, I'd expect volatility, whipsaw to kind of continue.
Got it. We're going to talk about international markets next, and it's interesting. For the first time in a couple of years, diversification has really paid off, with foreign stocks being up with double digits, right?
Yeah,
Close to it.
finally, good time to be invested internationally, which is great.
Yep.
We'll see if that continues. If this Made in America and bringing everything back to America kind of comes to fruition, that could be a little bit more pressure for them. But you're also seeing a little bit more of a protectionist stance kind of globally at this point. European countries are now thinking about spending more money, potentially even taking on debt to fortify their defense spending. So that's kind of booming their general markets at this point.
Got it. How about gold? I mean, gold seems to be up like 13, 14% year to date. I mean, it's
The rally
crazy.
continues, right?
Yeah.
Yeah. It's good to see. I think it's probably more of an inflation hedge and a kind of almost a flight to safety preemptively,
Okay.
more so than anything else. Commodities have been doing pretty well, kind of in face of all the other commodities kind of getting a little bit hurt right now.
Got it. Okay. What is the latest from the Federal Reserve and interest rates?
So it'll be interesting to see what they do. I think going forward the rest of the year, they're very much continue to be data dependent.
Okay.
Whether or not they make 2 cuts, 3 cuts, 4 cuts, maybe even 1 cut, if kind of the extreme end of the spectrum, I think it's very much going to be, if the economy is stable enough to handle that, then they're not going to cut. If inflation continues to come down, then they have an excuse to cut. But they're very much now waiting to see what happens. And just like everyone else, they're kind of just in wait and see mode right now.
Got it. We always preach, maintaining disciplined diversification. So to that end, have we made any changes to our portfolios? We kind of maintain that diversified mix.
Sure. So strategically, we always want to maintain full diversification. If you own everything in the market in your general market weight and you're managing your risk profile correctly, you're going to capture whatever is doing well. So thankfully, while the U.S. has been not doing as well this year, international markets have been carrying the load for us, kind of offsetting some of that volatility that we're seeing just in the U.S. We've done some tactical moves though, and I think that's kind of where the value from an advisor practice comes into play, is doing those Roth conversions, right? So we did a lot of Roth conversions when the volatility started to kick up, where it made sense for certain clients. So now whenever that recovery does occur, all of a sudden you're going to have that as tax-free growth as opposed to tax-deferred growth.
So with the market about 10% off the highs, we're locking in gains on bonds and kind of buying stocks on sale in the Roth IRA for clients, right? In the Roth.
Exactly correct.
Okay. All right, like always, we like to talk about the 8 laws of investing. Today, we're going to talk about law number 7, which is essentially there is no such thing as a normal stock market or normal economy. I think a lot of times investors are waiting for things to get better, quote unquote. Can you just talk about what that means in English?
Yeah, absolutely. So that's the classic timing the market versus time in the market, which is better for you long term, right? So for us, it's rather be in the market than try to time the market, even when the natural inclination, especially when there's some volatility and some unknowns in the world, the natural inclination is I want to get out of the market, or I want to sit on the sideline and wait till things kind of settle down But what you're really doing is kind of concentrating timing risk at that point.
Yep.
And what you really should do is try to diversify your risk as much as possible. And that's spread it out amongst all the asset classes, get it in the market, all different markets, and just working for you. Because as we know, markets like to go up. At some point, they will turn around. And that's when it becomes to your benefit.
Got it. So the only way to capture all the ups is to sit through all the downs, I guess, right?
Exactly. That's
Okay.
the price you pay for wanting to be an investor.
Thanks, everyone, for joining us. If you have any specific questions about your portfolio or specific financial plan, reach out to your relationship manager at Brandywine Oak.